Gold exploded higher, silver followed, and the crash everyone feared is officially over as the bears find themselves completely trapped. The so-called impossible V-shaped recovery just happened in 8 trading days, shocking analysts who confidently declared the bull market dead. Short sellers who mocked gold last week and promised silver would collapse to 50 are now being absolutely annihilated by price action. They said it was a bubble. They said the rally was finished. They begged you to sell near the lows. They told you to dump gold at 4,400 and silver near 63 while fear dominated the headlines. While panic spread, a massive buyer quietly stepped in and accumulated 148 tons of physical gold. This buyer was not a central bank, not a sovereign wealth fund, but a cryptocurrency company hiding in plain sight. Tether, issuer of the world's largest stablecoin, has quietly become one of the largest gold holders on Earth. They now own more gold than Australia, the United Arab Emirates, South Korea, and Greece combined. Today I will show you charts proving this was never a bear market collapse. It was a coordinated raid. I will expose the crypto giant dumping United States Treasury bills to buy physical gold every single week. And I will prove why global vaults are emptier now than before the crash despite falling prices, because while the price fell aggressively, the physical metal quietly left the system. That exact dynamic defines a supply squeeze masquerading as a market crash. Before exposing this new whale, I need to know who survived this volatility together with us. We are building the strongest community in finance, one that refuses to panic sell at engineered lows. This community understood the move was a shakeout, not a breakdown of fundamentals. Comment below where you're watching from and what time it is in your part of the world. New York, London, Singapore, Mumbai, Tokyo. Let the algorithm see that we are global and engaged. I will reply to as many comments as possible so we can make decisions together with clarity. Pause the video, comment your location, and let's get into the numbers proving we were right. Let's start with the scoreboard because the victory is now impossible to deny. Gold sits firmly above 5,000, reclaiming the psychological level analysts swore was gone forever. Silver trades back above 80, brushing off intraday noise after one of history's most violent crashes. Weekly performance tells the real story, not intraday headlines designed to scare weak hands. Gold plunged more than 20%, and media declared the bull market finished. 8 days later, gold recovered hundreds of dollars, delivering a near 15% rebound. That is not a dead cat bounce. That is a textbook V-shaped reversal. Anyone who shorted the breakdown is now trapped underwater with losses expanding daily. Anyone who sold expecting cheaper prices is watching the market leave without them. Silver experienced an even more brutal collapse, losing over 40% from its peak. Media confidently predicted silver would fall to 50 based on mean reversion models. We debunked that narrative using inventory math and physical demand data. Now silver has rebounded nearly 30% in 8 trading days. Let that sink in because markets do not behave this way in real bear markets. Yet mainstream media still calls this a bear market, ignoring what price action screams. The bottom is in and the next leg higher has already begun. The crash was triggered by policy fears, margin hikes, and forced liquidation across futures markets. Currency spikes and yield surges triggered margin calls unrelated to physical demand. Exchanges raised margin requirements, forcing leveraged longs to sell regardless of conviction. Algorithms piled on, liquidity vanished, and media spun a false fundamentals narrative. This was a paper market wipeout, not a collapse in physical demand, and the physical data proves it beyond dispute. As paper traders sold, real buyers stepped in with aggressive conviction. Major banks reaffirmed bullish targets and quietly accumulated metal during the chaos. The dip was bought ferociously by institutions, ignoring headlines entirely. The V-shaped recovery formed in real time for anyone watching positioning instead of news. Weak hands sold so strong, hands could accumulate. Last week headlines screamed bubble burst. This week they whisper recovery underway. The same analysts who warned you to sell are now chasing prices higher. Short sellers engineered a bear trap using margin hikes and fear campaigns. The trap failed, prices rebounded, and panic sellers donated metal to whales. Now let me introduce the new whale that changes everything. A bombshell report confirms Tether holds 148 tons of physical gold. This is not paper exposure, not derivatives, but real metal stored in secure vaults. A crypto company now ranks among the world's top gold holders. Their accumulation pace rivals central banks and exceeds most sovereign nations. They added massive tonnage even during the crash when media urged selling. Their strategy is clear: allocate a significant portion of reserves into gold. They are actively dumping treasury bills to buy physical metal. This is de-dollarization happening in real time by a dollar-linked entity. When digital dollar issuers prefer gold over government debt, pay attention. This is not speculation, it is strategic capital positioning. Tether understands unlimited printing destroys paper credibility over time. They trust a 5,000-year-old metal more than modern debt promises. Their actions validate the shift from paper claims to physical ownership. Vault data confirms massive silver withdrawals during the price collapse. Inventories fell sharply as buyers removed metal while prices dropped. That behavior only happens when physical supply is tight. If demand were weak, inventories would build, not collapse. Instead, registered silver drained at historic speed across exchanges. China simultaneously locked down exports and drained vaults aggressively. Metal flowed from exchanges into private and industrial hands. Once metal leaves vaults, it rarely returns at lower prices. March delivery demand threatens to expose paper shortages completely. The crash was engineered, but the drain was intentional accumulation. While retail sold, institutions quietly stacked metal. The paper market tried to kill the bull and failed in 8 days. The physical market absorbed everything and tightened further. This is not a recovery coming later. It is already happening. The bears are trapped, the shorts are exposed, and the next leg will be violent. Trust data over narratives, and remember, paper crashes fade, but physical shortages compound.